Welcome back. We are kicking off 2025 with one of our favorite themes or shows, the Brains Trust shows. And today we have the Brain Trust of the Kotak Group. As I told you, we have with us Shanti Ekambaram, Deputy Managing Director at Kotak Mahindra Bank, Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities, and Srini Sriniwasan, Managing Director at Kotak Alternate Asset Managers. Gentlemen and Shanti, thank you very much. And from all of us here in the newsroom and working behind cameras, a very happy new year to all of you, your families and everyone at Kotak. Okay, let me start with perhaps my favorite, banking. Shanti, first to you. How do you see the banking sector? Do you think that the war for deposits that we saw continues? Changing of the calendar, tearing that page is not going to make a big difference. We're going to continue to see pressure on liquidity, pressure on raising deposits, pressure on margins. Will that be the theme, at least in the first half?
So, Latha, if I take the last 2 quarters or even 3 quarters so far, you've seen deposit rates have been reasonably stable. You've not seen them sort of spike or have a runaway as far as the deposit rates are concerned. 2 factors to it. I think the system liquidity was fairly reasonable. And 2, it is a fact that there has been some moderation on the credit side as well. So banks have been able to raise deposit, but the cost of deposit that you asked and the rates have been reasonably stable. And I expect as we get into 2025, this will continue. Ultimately, it is a demand-supply ratio. Right now, it seems reasonably balanced. We have to see how economic growth happens, how demand for credit takes off, which we have seen some moderation in, and that will determine the trajectory of deposit rates. As I see it right now, stable.
Stable. So margins could continue to be under pressure, or that pressure is off?
So it's like this. Margins are a function of your lending and your cost of funding. Yes, it is not just the cost of deposit. It's also the mix of your lending, right? And I think if you look at an industry level, the mix of unsecured retail has come down. The mix of SME and some amount of corporate has come up. But banks will devise ways to see how they can sort of keep their names reasonably stable. So expect some stability and maybe some marginal reduction at the industry level on NIMs.
Okay. Point taken. I'll come back to you on this unsecured bit, which has become a theme in itself. But before that, Sanjeev, to you, I mean, I read your 2025 note, and you have been worried about urban consumption and the general slowdown. Does the December auto sales kind of ameliorate the picture a bit? After all, we did see the small car come back in the Maruti sales numbers. So perhaps the urban consumption slowdown is not all that bad and things are plateauing, no?
Latha, we'll have to wait and see, because it's obviously only 1 month that we have seen this number. Also keep in mind the fact that if you look at two-wheeler sales, numbers have been very, very bad actually. This looks like somewhere about low teens kind of a decline in numbers. So if you look at Bajaj Auto, was down 19%, Hero was down about 17%, which is quite surprising. Having said that, December is not a very big month for auto sales, so obviously there will be a lot of variation depending on what happened in the base month. On Maruti specifically, the hatchback segment volumes are very low in December 2023, somewhere about 2,600 units only. And that was something like a 74% decline from the December 22 month. So I don't know whether I need to really get excited about this big increase. We have seen almost 20% increase in volumes in December 24 versus December 23, or I need to look at the fact that December 24 versus December 22 is actually still a decline. So I would rather wait and see how volumes play out over the next few months before taking a more decisive view on this point. Having said that, the commentary from companies, whatever pre-result, releases have come out, seems to suggest that at least things are getting better compared to September quarter. September quarter was a complete washout. If you recollect, whether it was rural, urban, everything looked very, very bad. At least this time around, you saw the press release from DMart. At least looks like, some recovery seems to be there. Again, we'll have to wait and see whether this is for real, how long it sustains, and so on and so forth. But at least as of now, things seem to be better than the September quarter.
So what are your earnings growth expectations for FY25 and 26? I mean, either Nifty
So
or your
for
universe.
Yeah. So for Nifty, if you look at it, it's going to be very bad year for 2025. It's only 4.5% growth. But keep that in the context of the fact that you had very high numbers of BPCL in the previous year. You had some accounting change in Coal India, which boosted its numbers in FY 2024. So if you strip that aside, that is remove BPCL and coal from the base, then you are looking at somewhere about 10% growth for the Nifty
It's
50
not bad.
for 2025. For 2026, as of now, we have about 16% growth, uh, both on a reported basis, including BPCL and coal. And even without those two companies, also it seems like a similar 16% kind of a number. Obviously, we'll have to wait and see whether we see some money downward as we go through the year, because that's been the typical situation, right? And every year we start somewhat on the higher side, and then numbers start coming down. So as of now, we could be in a golden period of earning, in the sense, people have stopped bothering about 2025 numbers. Even if they're downwards, people don't care. But people have still not, started to cut 2026 numbers. Hopefully that would be the case, but let's see. I'm reasonably okay with 26 numbers forecast for now, given the fact that a lot of growth is actually coming from, banks, IT, etc., where we are a lot more comfortable with our earnings forecasts.
Okay, fair point. No, I'm sure Prashant also and Nigel have a lot of questions on specific sectors and stocks. But first question to you, Srini. This IPO, actually, people made a lot of money. There was a money control story which actually did the calculation. I think about 60% are still trading at a premium. So does the Diwali in IPO continue and investors will make money, you think?
Well, I think, if you look at the liquidity in the market, and as Sanjeev was mentioning earlier, people are discounting further and further out and ignoring the numbers for the short term. What we are also seeing is that there are new categories of companies which are coming into the market, and the inclusion of companies like Zomato in the index just tells you that the composition of how the market will look like over the next couple of years is changing. So all of these new service-oriented companies, or the new age companies, those which have achieved scale and who are now showing a trajectory of bringing down their burn, obviously having a positive rub-off effect on all other industries as well. So once people make money in the IPO market, the party will last as long as some other disaster doesn't strike. And right now we don't see a disaster around the corner, so maybe it will continue.
Okay, well, Shanti, let me come to the core problem that banks have faced. Up until 2013-15, we used to think of banks as lending to corporates, but that NPA blow-up made everyone come to retail. Otherwise, you used to think, HDFC Bank, ICICI Bank gave some retail loans. But now all PSU banks and then fintechs, everyone is only retail. And that explains why perhaps now we are starting to see over-lending, unsecured loan problems, MFI loan problems. How do you see that getting resolved? Do you think corporates are back in the game? And specifically for Kotak itself, do you think the unsecured issue is behind?
So let's look at the industry level. If you look at banks, Latha, they were always diversified. You had, corporate, what I call commercial credit, as well as retail credit. Commercial credit is really, including commercial vehicles, tractors, agriculture, and the like, etc. So when the demand for loan, you also have to look at where the demand for credit has come in the last 5 years, particularly post-COVID. Post-COVID, you saw the demand surge from consumption, urban consumption, exactly what you mentioned, that you're seeing some plateauing effect. This saw a surge, whether it was buying a property, whether it's buying cars, whether it is lifestyle, whether it's credit cards, etc. We saw a huge surge. So wherever there was an opportunity, I think banks and NBFCs and fintech, right? So banks, I would say, have a reasonably diversified portfolio. If you just talk about us, our unsecured retail is now just marginally below 10%, around 10%. So banks have a diversified retail portfolio. Retail, corporate, commercial. I think what you have to see is some of the fintech players focused only on the unsecured retail, and some of the smaller NBFCs moved towards that. So I think much has been said and written on it. You had the RBI warning, but if you actually see the growth in the last 2 quarters, and I was reading the RBI numbers, etc., it has come off in a big way at an industry level, right? From over 30-35% to now almost 10-15%. So I think that's where it is. As far as corporate is concerned, Are you seeing very big capex happening? No. But I think you do see certain sector investments, whether it's renewable energy, whether it's data centers, whether it's adding to capacity, which I call brownfield. So some amount of capex is happening. There's a lot happening in the mid-market and the SME sector where they are building for capacity. So I think there is opportunity across all the three segments. Retail has led the surge because of the consumption. As consumption, moderates, as we see, I wouldn't call it this thing as plateaus. You will see an equal focus across. And ultimately, it depends upon what rates, because it has to be win.
Absolutely. Good morning to all three of you, and wishing all three of you a very happy new year. Prashant this side. Sanjeev, if I can come to you, Shanti mentioned data centers, renewables. I mean, I'm just taking off that and sort of building on that. We've discussed and you've illustrated with the specific examples on power as a sector, some of the absurd valuations at which stocks are trading at. But it's a space, you're smiling, and we've had this conversation many times in the past. But in 25, Sanjeev, is it, since earnings growth is going to be tough to come by, will even slower earnings growth get stocks to move? I mean, 10% plus kind of earnings growth, will it be enough? And which areas you think, Sanjeev, where you think one can still find opportunities?
If you go by valuations, and that's where the struggle really starts. It's not as if we are debating the growth prospects of the economy. I mean, we are still looking at 6% for next financial year, inflation coming down. So the macroeconomic fundamentals seem to be in reasonably good shape, I would say. The challenges are henceforth. The first is the starting point of valuations. Valuations have stayed high, despite the fact that you had a pretty stagnant market, I would say, for the last 6 months. What has happened, unfortunately, we have seen a lot of earning downgrades in some of the consumption-related sectors, which means the valuations have not really come up. Most of if you look at the consumer staple names, most of them are north of 45p even now, despite very, very abysmal top line and bottom line growth as of now. So obviously, investors are still hoping that at some point in time you will see some recovery in rural demand, urban consumption, and so on and so forth. But the signs are still challenging, I would say. So consumption for me is ruled out for the time being, very expensive with not so great fundamentals. If you look at the investment part of the market, slightly more exciting stuff happening over there. At least the investment cycle is doing quite okay. If I look at government capex, I think 2026 should see a big recovery compared to 2025. For the simple reason, 2025, the government simply did not have enough time to spend the money. I mean, the first 4 months spent in elections, formation of government, and so on and so forth. Capex number is down 12% in the first 8 months. And the government space seems to be in decent shape. So hopefully 26, we will see a decent recovery in capex. Thankfully, residential real estate demand continues to do pretty well. And that's one part we are still quite positive about. If you look at the outsourcing sector, which is IT and pharmaceuticals, we are okay on both. Obviously, both benefit from weaker currency and so on and so forth. We'll have to wait and see if any of the policies of the incoming administration in the US are positive or negative. Hopefully, neutral to positive. Let's see, how things pan out. Valuations are high over there. If you look at the pharmaceutical sector, stocks gone up a lot in the last 6-9 months. But I can live with that. At least the company are showing pretty decent top line growth as also bottom line growth. Which brings us back to the banks and NBFCs, where valuations are very reasonable. Shanti talked about some of the issues over there, but I don't know whether that's enough to result in the kind of punishment we have seen for the banks in general over the last 2-3 years. A lot of derating has happened, and assuming that you don't see further bad news on the NPL side, at least most of the banks are doing now 13-15% ROE, whether it's a PSU bank or a private bank, most are in that range. So I am hoping for ROE linked return for the banks in general. I'm ruling out any re-rating for the time being. If we get re-rating also on top of that, well and good. But as long as the book is growing at ROE, and that's the return to expect, I would assume, for the banking sector. So that's how I would summarize our positioning on the market for now.
Okay. Well, Srini, can you round up how private equity might work? I mean, after all, the US is a big magnet now with dollar and rates in favor of US exceptionalism. will money come in? And, actually, you all have been filling the gap which banks are lending to corporates. Private credit is lending, but Reserve Bank warned that, the NBFC connect with private credit can mean that some of the loans are just getting, bad loans are just getting kicked. The can is getting kicked. So just tell us, will it be a good year of private credit? Will Indian alternate assets find more takers?
Well, I think if you see, there are three parts to it. You started the question with private equity. I think most of the private equity folks are focused on getting exits, and new allocations are hard to come by. First of all, on account of the LPs not getting enough money back. And India is the only exception, really speaking, where people are able to get exits, and sizable exits at that, thanks to the public equity markets that's been doing very well. On the private credit side, I think Shanti and Sanjeev alluded to that earlier in terms of credit growth. A lot of the credit growth is happening on, infrastructure, in renewables, and some of the newer sectors where maybe some of the banks are a little wary of, having large extension. And we are seeing some structured transactions that we can put capital out to. And many of the private credit market players right now, which is now getting a little crowded because while capital was not available globally because of attractive US dollar returns for US investors, a lot of capital is being raised from the domestic market. So what I do see going forward is that while the private credit market will continue to grow at a healthy clip, there could be situations perhaps 2 or 3 quarters down the road where excess capital or some kind of mispricing of risk is likely to happen, perhaps in the September-December quarter of this year. So while private credit is going to be a good place to be putting your capital to work, you just have to be careful in terms of who you put the capital to work with. I think the other thing that we see a very significant positive coming out of where we are is, I think Sanjeev alluded to residential real estate. We also see very significant opportunity from an investor point of view on the office asset class. There isn't enough build of office space going on, and the global capital centers are actually ramping up capacity utilization. And that means that you are going to have reasonably tight office markets. And those who are in Mumbai already know that rents have shot up significantly and not enough supply coming in right now. So I would say all in all, it will be a year in which you should be possibly thinking of allocation to non-equity assets at this point in time, be that credit or hard assets, and there will be pockets of opportunity. Government and asset owners of infrastructure assets will have to recycle their assets, which means sell stabilized assets to build new assets. And the new bids on solar, for example, which are actually more attractive than actually buying an existing solar platform. So there is going to be a fair amount of churn in terms of solar platforms being available for sale. So it's going to be interesting opportunities to earn good annuity risk-adjusted returns, as well as when you have the appetite for higher risk to get into high-yield credit strategies. So overall, while capital raising is still going to be a challenge, so one is going to be relying more on the domestic capital base to raise even alternative capital as opposed to international capital. That's the way I would sort of sum it up.
Okay, that's an excellent wrap of a very vast topic. Thank you very much, Srini, Sanjeev and Shanti. Unfortunately, out of time, not out of questions, but we do hope all of you and everyone at Kotak have a brilliant 2025. Well, that's the word coming in from the Kotak Group. Cautious, optimistic, but cautious.
Absolutely. And, we'll have more opinion over the next few days as we sort of, really get started and get into 2025. Well, that was an interesting chat. Midesh.